Welcome to the deep dive. You're tuning in because, well, you want to get up to speed quickly on how auditors handle communication and reporting for internal control, specifically in an integrated audit.
That's right. We've sifted through the professional standards, the auditing rules, basically.
And our mission today, it's simple. Boil down those key requirements. What do auditors have to communicate and report when they find weaknesses in internal controls?
Exactly. We want to give you the core info you need, whether you're dealing with, public companies or private ones. It's vital stuff.
Okay, let's dive right in. Starting with companies that aren't publicly traded non-issuers, what are the communication rules there when auditors spot issues?
Right. So for non-issuers, if an auditor finds either a significant deficiency,
Okay, what's that exactly?
it's less severe than a material weakness, but still important enough that the people those charged with governance really need to know about it.
Got it. And the other type?
A material weakness. That's more serious. It means there's a reasonable possibility that a material misstatement in the financials won't be prevented or caught on time by the internal controls.
Okay, so significant deficiencies and material weaknesses. What happens when they find them?
Both of those must be communicated, and crucially, in writing,
In writing, to who?
to management and to those charged with governance. Think the board or the audit committee. And this has to happen by the report release date at the latest.
What if management fixes the problem, like, right away during the audit? Does the auditor still have to write it up?
Yes, absolutely. Even if it's corrected, that written communication is still required. It's about the record.
Makes sense.
And if these are issues that have come up before and haven't been fixed, the auditor can actually just refer back to the previous letters they sent. Saves a bit of rewriting.
Okay. What about smaller issues, things that aren't quite significant deficiencies?
Good question. Auditors also need to communicate all other deficiencies they identify, even the less severe ones, to management. Again, in writing.
All of them.
All the ones they find. And this needs to happen within 60 days after the report release date. They also have to tell those charged with governance that they've had this communication with management. Just a heads up.
So there's this ladder of communication.
Pretty much.
Yeah.
And there's one more important point here. If the auditor thinks the audit committee isn't doing its job effectively, specifically overseeing financial reporting and internal control,
Uh-oh.
yeah, it's serious. In that case, the auditor is required to communicate that concern in writing directly to the full board of directors.
Wow, okay. That's a big step.
It is. It's also worth noting, auditors aren't obligated to specifically search for every minor deficiency. But if they do identify them during the audit, they have to report them, as we just discussed.
And they can't just say, everything looks good, no problems found.
Definitely not. The standards prohibit stating that no deficiencies or no material weaknesses were identified.
Okay, that covers non-issuers pretty well.
Now, how does it change for public companies, for issuers? Are the rules different? They are similar, but with some key distinctions, especially around timing.
Like what?
For issuers, all material weaknesses must be communicated in writing to both management and the audit committee before the auditor even issues their report on internal control.
Ah, so that's earlier than for non-issuers, before the report date.
Exactly. Timing is tighter. And significant deficiencies, they also need to be communicated in writing, but just to the audit committee for issuers.
Not necessarily management.
Well, the communication goes formally to the committee. And like with non-issuers, those lesser deficiencies get written up for management, and the auditor tells the audit committee about that communication.
And the ineffective audit committee point.
Same rule applies. If the auditor thinks the committee's oversight is ineffective, they have to write to the board. That's consistent.
Got it. So faster communication on the big stuff, slightly different channels, but the core idea of informing management and governance is the same.
Spot on. And the points about not having to search for every little thing, but reporting what you find and not saying no deficiencies found, those also apply to issuers.
Okay, communication down. Let's shift to the actual reports auditors issue on internal control, back to non-issuers first.
Right. For non-issuers doing an integrated audit, the auditor must issue a report expressing an opinion on the effectiveness of internal control.
Must issue one. Can it be part of the main audit report?
Yes, they have options. It can be a separate report just on internal control, or it can be combined with the financial statement audit report.
What goes into, say, a separate report?
You'll typically see key sections. There's the opinion, obviously. Then a basis for opinion section, sections outlining the responsibilities of management and the auditor. And importantly, a definition of internal control and a discussion of its inherent limitations.
That inherent limitations part sounds important.
It really is. It often gets tested, this idea that even the best internal control system can't guarantee preventing all misstatements. Human error, collusion, management override,
Yeah. Right, those unavoidable risks. And a combined report.
It essentially weaves all those same elements together with the financial statement, opinion, and details.
What about the date on the report?
Crucial point. The report date can't be earlier than the date the auditor got sufficient appropriate evidence. And, importantly, it should be the same date as the audit report on the financial statements. They go hand in hand.
Okay. Now, what if they did find a material weakness for that non-issuer? How does that affect the report?
If a material weakness exists at the as of date, the date internal control is being assessed, the auditor must issue an adverse opinion on internal control.
Adverse, so basically saying it's not effective.
Exactly. The report has to explicitly state that a material weakness exists, include a definition of what that means, and usually refer to how management described it in their own assessment, if they did. The auditor also considers how this weakness might affect the financial statement audit itself.
And if management doesn't mention a material weakness that the auditor found, or doesn't describe it fairly?
The auditor has to call that out in their report, too. They need to describe the material weakness directly. Transparency is key.
Makes sense. Okay, how does this reporting look for issuers? Similar principles.
Very similar. Issuers also get a report on internal control effectiveness, either separate or combined.
But maybe some different references?
Yes. Issuer reports will specifically reference the standards of the PCAOB, the Public Company Accounting Oversight Board.
Right, the regulator for public company audits.
And they're often mentioned the control framework used, like the COSO framework, which is very common.
COSO. Got it. What about report dates and material weaknesses?
Same rules apply. Report date aligned with the financial statement audit no earlier than sufficient evidence. And an adverse opinion is mandatory if there's a material weakness, including defining it and identifying it in the report. The auditor also has the same responsibility if management's reporting on weaknesses is deficient.
Any unique reporting aspects for issuers?
Yes. There's a possibility for what's called a voluntary engagement. An auditor could be hired later to report specifically on whether a previously reported material weakness has been fixed, eliminated.
Oh, interesting. So like a follow-up check.
Kind of. But it has strict conditions. The auditor needs enough knowledge, management has to take responsibility and provide their own assertion about it being fixed, and the auditor's testing is limited just to that specific control.
Okay, good to know. Are there any other sort of general reporting issues we should touch on for both types of companies?
Yeah, a couple of important ones. First, scope limitations. What if the auditor can't get the evidence they need to form an opinion?
Right, what then?
They might have to withdraw from the engagement or issue a disclaimer of opinion, basically saying they can't give an opinion. But even in a disclaimer, if they did identify any material weaknesses during their work, those still have to be described in the report.
Wow, even if they disclaim an overall opinion.
Yes. Also, sometimes audits involve other auditors, maybe for subsidiaries. The decision whether to reference that component auditor's work is made separately for the financial statement audit and the internal control audit.
So you might reference them for one but not the other.
Potentially, yes.
Yeah.
And finally, subsequent events, things that happen after the balance sheet date or the as-of date for internal control.
How do auditors handle those?
They have procedures like making inquiries, getting written representations from management, looking at relevant documents. If they find information about a condition that existed at the as-of date before they issue the report, they have to consider it. If something new arises after the as-of date but before the report, they might add an explanatory paragraph describing it.
But they don't have to keep checking forever, right?
Yeah, after the report date, they don't have an obligation to keep tabs.
Yeah.
But if they do become aware of something that existed back then and would have changed the report, they need to take action.
Okay, that covers a lot of ground. From who needs to be told about weaknesses and when.
Right, differentiating between non-issuers and issuers.
To the structure of the actual audit reports, adverse opinions, scope limits, and even subsequent events. It's definitely a layered process.
It absolutely is. You can really see how the rules try to ensure that management, the board, the audit committee, and investors or stakeholders get the necessary information about how well a company's controls are working. It's all about transparency and responsibility.
So thinking about all these detailed requirements, the specific communication lines, the formal reporting, the consequences like adverse opinions, what does this intricate system really tell us about just how critical transparency and accountability are considered in the whole financial auditing world? Something to think about. Thanks for breaking that down for us.
My pleasure. It's complex, but definitely crucial.